Let's pivot a bit over to the public equity side. This is bread and butter, something that Grow's been really focused on. So let's start with the announcement that you made recently about building a fund of funds that will help global investors get alpha access to Chinese managers. Why don't you walk us through the mandate there? We're working on something that, just for full disclosure to our guests, we're trying to work on something through our QFI platform with Grow, which is going to be really exciting. But from a bird's eye, 30,000 feet perspective, walk us through why you're building this now.
Sure. Alvin, given we have been in the industry for more than 20 years, starting joining the industry when we were 3 years old, I think we've seen the up and downs, the cycle in the global and Asian alternative investment industry. Back in the old days, there is a lot of so-called beta exposure when fund manager was up 150% in '07. I still remember everyone celebrating and they're charging 20% performance fee. And then '08, you go down and then you have other things. I think the similar things is happening in the China market. I would start with describing what regulations or the trends in China asset management first, and then I'll touch a bit on the opportunity and why we are doing it now. If you look at China, it's a very unique alternative investment industry. We are talking about 28,000 private equity fund and hedge funds in China, managing about 2.5 trillion US dollar and growing very fast. And then this is compared to around 3.5 trillion size of the mutual fund, market in China, which alternative investment is a huge bucket in China. But going forward from our analysis, we believe the regulators and the distributor and the clients are seeing a consolidation of the industry in which if you are not the top tier 10% of the industry, the mid and small size player will be being squeezed out. It's kind of like what happened in the US and Europe market 10 and 20 years ago. So China right now, given the volatile market environment and the slowing down economy, even the asset management industries being a consolidation. And this is a music to our ears. This is our opportunities. Because when the whole industry being squeezed and being consolidated, certain strategy, certain platform will be the future winner. And we believe the multi-strat alpha type is the future winner. And Alvin, I'll add Chinese story, if you don't mind. And people are talking about, this is a rule, MBA 101 in the Hong Kong and China. When you think about a product, there are 4 steps that you are trying to pivot or do. The first one is they call it 人冇我有. So when there is no other supply of it, when you have your own supply, then you have a business case, you have product 人冇我有. When there's nothing, you have this product, basically you create the first product in the market. And then the second stage is 人有我優, meaning that when similar product being launched in the market, supplied by the market, you create a higher quality, a better quality to the market. 人有我優. So this is the second stage. And then the third stage is 人優我廉, meaning that when the quality of the whole industry has been increased, then you go down, price decrease. You suppress the market with lower price, commoditization of the whole product. And then the last stage is, maybe you haven't heard it before, but I think it's quite funny, is 人廉我跑. When the overall industry, the pricing is being squeezed, you run away, you launch another new product. So basically, it's 4 different cycles of a different industry in China, in Hong Kong, when a business owner trying to do this. And I would describe in the global market space right now, alpha is really unique. Beta is really commoditized. So we are seeing a huge spread. If you're running a beta strategy, low pricing, ETF, direct access, etc., the fee margin is really low. When you have a true alpha globally, basically some of the big firms, you can charge 20 to 30% performance fee for that alpha. So this is the third, if not the fourth stage I would describe in the global space. But in the China market, we are still very early. We are in the first 2 spaces, meaning that the first is if you come up with a new unique strategy, like what we did about 4 years ago, convertible bond, basically you can charge huge performance fee, huge margin for this, and the return is good. And then some of the strategy is when there is a lot of copycat coming in, then you upgrade yourself, become a premium, unique opportunity. So back to the question, Alvin, is why at this point? Because we are seeing the consolidation of the industry due to the regulations, due to the investor, they want to invest in more solid, comprehensive platform. And second is there is also more supply of talent, because historically a small fund manager, they can run their own shop, launch their own product. But now it's that stage when the regulations, compliance, prices increase, when you need to have a more robust operation and system to do it. They have to combine the platform. That's why when I was at Noah and Gover, we launched the first multi-strat fund in China, and we grow the business from 10 billion to 26 billion. We're actually trying to do the same thing in Grow. And now we are at the stage that we think alpha is truly available in the China market. And there is a lot of good, unique portfolio manager or strategy that are happy to join or come into the Grow platform. Hence, I think from a demand side, supply side, and regulation side, this is the best timing for us to launch such a strategy. And let me finish, Alvin, by giving you one example. We hired a quant manager about 3 months ago. They were doing quant market neutral strategy at a mutual fund. And 3 months at Grow, they were already up 6%, market neutral, 2 by 2. And then historically, if we want to hire them, we have to pay 1 to 2 million US dollar, as a salary. But now they join us as one of our portfolio manager with some revenue sharing. So we are in a stage of distress in a sense that the talents are being distressed. That's why we can absorb them and then create strategy around them.
You mentioned a quote earlier, 28,000 investment managers in China. And even though it's going through a consolidation phase, it's still an enormous number. I think the breakdown between privates and publics is roughly 50-50. So let's say on the hedge fund side, the alpha generators on the public markets is roughly 14,000. Put into perspective, the entire Eureka Hedge database, is roughly about 15, 16,000. So it's almost a one-to-one ratio in terms of the amount of talent that we find onshore in China versus the global registered database, which is enormous. I would imagine, William, if we could just tap into the top 1%, you could have a very, very robust product offering. A lot of the investors ask me about capital controls, which is a critical part of it. And this also creates actually an opportunity for alpha, in the case most recently with QFI. And so QFI allows investors now to access onshore derivatives, including commodities futures, financial futures, as well as some of the names that are not covered in the Hong Kong Shanghai Connect. When you talk about alpha, are you referring to this new set of derivatives that offshore investors haven't been able to access? If so, what type of strategies do you think would work now?
Yes, I think this is a subset of the overall alpha. Our definition of alpha is relatively more stringent, because when there is not many available hedging tools like 5-6 years ago, basically people called it absolute return or dirty hedge, or you are taking some basis risk when single stock shorts is not available. So for the true alpha part, we would use global risk management model like Barra to measure different factors, and we would like to limit and disclose the factor risk that we are taking, right? So in general, why alpha is more available in the China market is because of the retail sentiment and also some of the unique characteristic. Like one example I usually quote now is being publicly discussed is the Chinese convertible bond, right? So they have a downside refix and there is low limit up, limit down feature before. Now the limit up, limit down is 30%, but the China A shares limit up, limit down is 10%. So a lot of the retail investor, they are trading the Chinese convertible bond like they are trading options. They don't even look at the price, or they don't look at the core optionality of the underlying. So I think this type of alpha is hard to believe for global investor, but it just happened because China is in the different stages. So I think this is one of the example. And then for QFI to invest in the China market, besides convertible bond, we are also seeing very unique opportunity like the quant space that I mentioned. I think historically, a lot of the quant signal is price and volume, the technical indicator. But with the availability of different data set, we are seeing further and further opportunity in using fundamental factor to do some quant market neutral. And the data set is very unique. Some of them are actually generating or gathering their own data set. And to put some number into perspective, right? So a lot of global investors are puzzling, saying, oh, they have seen or they learned some of the big global firms, no matter multi-strategy, quant or equity long short or long bias, when they go to the China market, whether they would outperform the local guys. So over the last 10 years, with invest, study, and compare, I would say there is mixed signal. Some of the domestic manager, they actually outperform the global guys. Some of them underperform. So the overall sentiment is the global institutional professional asset manager, the tier one guy, when they enter China, they're running head to head or at par with the domestic one. So I think my point is, through QFI, if you can access and identify some of the mid-size, up and coming unique strategy, then actually they would outperform some of the bigger guys. So back to your question, Alvin, besides convertible bond, quant market neutral, I believe there is down the road some very unique opportunity that I keep repeating saying is on the options and derivative market, because the structured product in China is growing. They call this low ball, and there is a lot of volatility trading or arbitrage related strategy emerging. I think that would be also like liquid alpha type of strategy, because Chinese retail, they love structured product, or they buy or they sell put option without kind of like focusing too much on the underlying pricing. On the other hand, for the traditional long only or equity long short type, I think the competition is quite high. So if you want to outperform the mutual fund, you need a lot of research. Like the fund manager that we hire from that particular mutual fund shops, they said they have like 200 research analysts just covering different sectors. Even in healthcare, they have 10 analysts covering Chinese medicine and some other stuff. So I would say if you go to China, the long only part would be highly competitive, and you don't have to pay hedge fund fees. So you go to the mutual fund managers and then you can get some of the sector fund. So I would argue that maybe some long short or some manager that can short market neutral, convertible bond, to some extent CTA, and the future part would be the volatility related strategy would be interesting and comprehensive to global investors or other global portfolio.
Just to step back to talk about quant for a bit, we both had experience with some leading quant managers who came from Shanghai and established their offshore business for global investors, say here in Hong Kong. A lot of them actually had a lot of challenges in porting that strategy, especially for equity long short market neutral, partly because the inventory offshore was quite difficult to get. So you building truly market neutral strategies with paired trades was very difficult. Some of them had opted instead to shift over to hedging with index futures as a result. Not sure if that takes a bit off the edge for alpha. What are your thoughts on that and how it affects investors' appetite and the case for going onshore versus offshore?
Yes, I think the shorting part or the flexibility onshore would create a different tools compared to offshore, definitely. In particular, the inventory for the mid and small cap, if you like. If you're doing, offshore and swap, I think the inventory and the cost of borrowing would be higher. Sometimes the right timing is important, Alvin. If you want to construct a market neutral product 3 years ago when there is not many inventory, offshore could be a challenge. My observation or advice is you try not to overblown your capacity for one, because some of the manager, when they go offshore, they want to repeat what they have achieved onshore, right? 1.5 billion US dollar, 3 billion US dollar, boom, and then you got bottleneck in your capacity. And second is we might as well try to be a little bit more concentrated rather than super diversified. We've seen or invested in some managers, they're able to construct a portfolio not 200 by 200, 200 shorts, 200 long. But they can do it with 50 and 50, 50 long, 50 shorts, and then you would have a balanced portfolio. So in that regard, maybe you are taking a little bit on the stock level concentration risk, but those names are liquid. But at the same time, you're not like being a hostage of the inventory or the borrowing. So again, there are managers that who did it in the kind of like with their trade secret sources way. There are also some manager trying to do it the traditional, really balanced portfolio way. And I think for us, bottom line is numbers speak for itself. We look at the factors, we look at the underlying exposure. If that makes sense, maybe we don't classify it as pure alpha strategy. We classify as a nimble equity long short or quant market, not market neutral, but a quant no net long short with some long exposure. And then you give them a hurdle. Maybe you don't give them too much performance fee. That works as well. And last but not least, in China, there is also some mechanism, which I think, Alvin, you would also heard about it. It's called DMA by the brokers, in which some of the mid-sized managers, they're able to, with the broker, to use a slightly higher leverage. Because in China, the quant strategy, they are doing one by one. So 100% long, 100% short. Basically, your gross is 200. But some of the brokers through DMA, they can let you to do 2 by 2 or even 3 by 3. And the funding cost is really cheap because the risk-free rate in China is cheap. compared to offshore. So I think those are also a strategy that if you go deeper, turning the rocks, and they can create you a low teens type of return with 0.1 beta, 0.15 beta in the China market. And those are very interesting to me.